What if I told you that while you were sleeping, a single quiet decision inside the United States Senate sent a ripple through the entire crypto market? There were no loud breaking news alerts, no dramatic crash banners, no viral tweets screaming panic. And yet, Bitcoin paused. XRP slipped. Coinbase reacted. Something shifted. Most people didn't even notice. Today I want to tell you what is really happening in the crypto world right now. Not rumors, not hype, not fear bait, just real developments, real data, and real consequences that could shape where this market goes next. If you hold crypto, this matters. If you're thinking of buying, this matters even more. Right now, the crypto market feels unusually quiet. There is no explosive pump and no brutal collapse. Bitcoin is moving sideways. Altcoins are cautious. Volatility is low. To many people, this looks boring. But in reality, this kind of market behavior is often the most important. When Bitcoin consolidates instead of collapsing after a strong move, it usually means one thing: the market is waiting. Not weak, not dead, just waiting. Bitcoin today is holding key support levels. Buyers are stepping in where they need to. Sellers are no longer aggressive. This is not panic selling. This is not a loss of confidence. This is consolidation. Historically, these moments appear when larger players are positioning quietly, not when they are exiting. The price is stable because no one wants to make the first big move until clarity arrives. And that clarity is tied directly to what's happening in the United States right now. A major U.S. Senate crypto regulatory bill, one that was expected to move the industry closer to long-term structure, has been delayed. Not canceled, not passed, delayed. The reason is critical. Coinbase, the largest U.S. crypto exchange and one of the strongest advocates for clear regulation, publicly withdrew its support for the bill in its current form. That single decision mattered more than most people realize. When Coinbase stepped back, markets reacted immediately. Bitcoin dipped slightly. XRP dropped more noticeably. Coinbase stock moved. This wasn't fear. This was recalibration. Investors suddenly realized that even pro-crypto companies believe the bill needs changes before it can safely move forward. This moment exposed something important. Regulation itself is no longer the enemy. Unclear regulation is. Markets don't collapse when rules exist. They hesitate when rules are unfinished, rushed, or ambiguous. That is exactly what we are seeing now. It's important to be clear here. This bill did not ban crypto. It did not make Bitcoin illegal. It did not target individual wallets. What it did do was raise questions about who controls crypto markets, how exchanges are classified, and which government agencies hold final authority. And markets hate uncertainty more than anything else. When answers are unclear, prices pause. Altcoins felt this pressure more than Bitcoin, and that's completely normal. Bitcoin is seen as the strongest, most resilient asset in the crypto space. Altcoins, especially those historically tied to regulation and legal interpretation, react faster and harder to political news. XRP is a perfect example. With its long regulatory history, any sign of uncertainty causes traders to reduce risk quickly. That doesn't mean long-term confidence is gone. It means short-term positioning is cautious. While social media focuses on price dips and drama, something far more important is happening quietly in the background. Institutional interest has not disappeared. Bitcoin-related ETFs are still active. Large investors are not fleeing the market. There is no mass institutional exit. Long-term support remains in place. This matters because in every previous cycle, the biggest accumulation phases happened when retail attention faded and patience was tested. At the same time, another real story emerged today from New York. The Manhattan District Attorney called for stronger laws to fight crypto-related crime. Some people instantly interpret this as anti-crypto. It's not. This is about fraud, scams, and criminal misuse. Long-term, this kind of enforcement actually helps the crypto industry. Scams destroy trust. Trust is what brings institutions. Cleaner markets invite serious capital. Regulation against crime is not regulation against innovation. What makes this moment different from the past is context. In earlier cycles, governments didn't understand crypto. Institutions were unsure. Crypto was treated like a risky experiment. Today, that phase is over. Crypto is no longer asking permission to exist. The discussion now is about how it will be structured and integrated into the financial system. That shift alone tells you how far the industry has come. Right now, smart investors are not panicking. They are not chasing green candles. They are not blindly trusting influencers. They are watching regulation, managing risk, and thinking long-term. Periods like this don't feel exciting, but they often form the base for the next major move. Looking ahead, there are only a few realistic paths forward. The Senate bill could be rewritten in a more balanced way, which would likely calm markets and restore confidence. The process could drag on, leading to more sideways price action and accumulation. Or a clearer pro-innovation framework could emerge, boosting institutional confidence even further. Notice what's missing from all of these scenarios. There is no realistic case where crypto simply disappears. If you're feeling confused right now, that's normal. If you're feeling impatient, that's human. But the biggest opportunities in crypto rarely appear when everything feels obvious and comfortable. They appear when the market is quiet, uncertain, and emotionally exhausting. This is one of those moments. Crypto is not crashing today. It's not mooning either. It's evolving. And the people who understand that difference will be ahead of the crowd.